On the podcast with us today is Dustin Miles. Dustin, welcome back to the podcast.
Hi, thanks. Super excited to be here. Thank you.
And if you guys heard that, I said welcome back because Dustin was on a couple of weeks ago with another episode. So you'll want to check his other episode out as well. It was a 147 unit one, I believe, called Aspen Walk. Is that correct?
That's correct. Yes.
Yeah. So go check that one out as well. He has gone full cycle on that one already. And this is another one that we're going to go over today called Fleetwood Square, located in Waco, Texas. And it's a 120 unit one. And he acquired this one in December 2016. And just recently this year in April 2019, sold this one. So we're going to dive deep into this particular acquisition. And but before we do that, Dustin, some people obviously, it might be their first time hearing you and things like that. So give them a little bit more of a background about yourself and where you are right now in the multifamily space.
Yeah. So I started in multifamily. I started passively investing about 7-8 years ago. I'm in Fort Worth, Texas, in the Dallas-Fort Worth area. And so started passively 7-8 years ago, started syndicating 5-6 years ago, did my first deal, syndicated my first deal in 2014 is 109 units in Haltom City, which is close to Fort Worth. By training, I'm an engineer, went to UT Austin, Hook 'em Horns. And so love, big into numbers. Engineering by training. So I need to have, plan A, B, and C. It's how I roll. And, so super excited to, not only from the perspective of, so I'm an entrepreneur, I've had businesses my entire life. And so this is, really excites me. But, from the more social aspect, one thing I really like to do is give back to the community. A lot of what we purchase is, it's working class. Some people are maybe, working paycheck to paycheck, things like that. And so we really try to give back to the community. 100 units, our expenses are 40, 50 grand per month. If we do something fun, every month or every other month, and it's a few $100s, it's really a drop in the bucket. So for this month, we're doing some properties. We're doing a snow cone event. It's going to cost us $300 for 2 hours, and we're bringing a snow cone truck stand out to the parking lot, and we're inviting all the residents. And the first 80 snow cones are on us, and then after that they can buy more if they want. But just trying to give back to the community, and then same token, make nice returns for passive investors.
Sure, and that's great. I've seen several different operators starting to do some of those community events with their apartments, and I think it also helps get more of that community atmosphere in your property, so you get people to renew more and more as well. And of course, you get people outside of the community that see that and they go, "Man, I want to be a part of that," and it starts to increase your new leases that you get on as well.
Yeah, for sure. Yeah, it makes business sense. It's a feel good, and I think it's just the right thing to do.
Yeah. So let's dive into this Fleetwood Square located in Waco, Texas. It's 120 units. I know it was back in December of 2016, so there might be a few cobwebs that you have to push away, but
Sure.
Talk to us about how you originally found this deal.
So this was an off-market deal, actually, as the other deal that we talked about a few weeks ago, Aspen Walk. This deal is an off-market deal. I regularly call brokers, and I've been doing this for a little while. But really, whether you've been doing it for a long time or not, if you're not cultivating those relationships with brokers, then it's kind of a moot point. But I regularly call a handful of brokers, so there's one particular broker. He's out of Austin, and so I talk to him probably, every month or every other month, just, "Hey, how's it going?" And, get to know each other and kind of, just talk about family and life too. But, got to know him, and I was like, "Hey, I was touring a deal." I remember this. I was touring a deal over in Longview, and I was driving back, and I was with a friend of mine. And so I was like, okay, I don't like to waste time. So I make a few phone calls. So called this broker, and I was like, "Hey, how are you doing? Blah, blah, blah. And you got anything going?" He's like, "Well, actually I have 3 different deals in Waco." I was like, "Okay, cool. Great. Can you send me info on them?" And And he didn't have a whole lot at the time, but he had the addresses, and I don't even know if he had the P&Ls initially, but and I just happened to be going to Austin that weekend, and so I drove by Waco's on the way to Boston from Fort Worth, and so drove by, and two of them were too rough for my liking, and the locations weren't as strong, but this one, Fleetwood Square, was in a good location, fairly clean. So I really liked the deal, and I offered on deals in that particular submarket of Waco as well. So, I just started going down that road, and I put in, got the pro forma from the management company, and started going down that road. It was a CMBS assumption, which was tricky. I tried to do as much homework as I could. There weren't a whole lot of people that I knew that had done a CMBS assumption. And so if anybody is doing a CMBS assumption and needs, wants to know tips and things like that, I'm happy to help. Feel free to reach out to me, because it is a little tricky. So it took us, we got under contract. I was shocked the buyer didn't, I submitted an offer expecting them to kick back a number, and they accepted our first offer. I was like, okay, I like this. And, so feeling really good. We bought it for, I don't remember the exact price, but 33, 34 door, in that range, where, the people buying now, if you're familiar with prices and even secondary markets of Texas, that's a pretty nice basis to be in at. So anyways, we got under contract, and it was a very slow moving process. And I think I had under contract in March of 2016, and we did not close until December of 2016. And a lot of that had to do with the lender, which was interesting. I was actually on vacation with my family in Europe, and the deal was falling apart. And so that made, it was interesting, having to set up calls while I'm in Munich and things like that. And so as far as what was falling apart was, so the lender did an inspection. They hired this engineering team that traveled from Beverly Hills, or no, I'm sorry, it was Orange County, California, to Waco, Texas, and they wanted us to replace all of these items. And so they were putting our replacement reserves, which are typically around 250, 300. Sometimes they're a little bit higher, sometimes, maybe a little bit lower. But they were putting the replacement reserves at about $700.
Wow.
Which is, so I was like, oh my gosh, that's a lot of money that we're is being tied up by the lender. We'll get it eventually, but that's a lot of money to be tied up by the lender. And then the other issue was, we had a pretty stout rehab budget. I normally go in anywhere between $3,000 and $5,000 a door. I was about 4,000 or so. But the problem is that they wanted me to replace a lot of things that I wasn't prepared to replace, such as windows. And I think they wanted me to replace all the ACs and some other stuff, just stuff that's not typical. And so they had a rehab budget of $350,000, but it was, my rehab budget was about $400K or so, or I guess a little bit more, but their items were not, included in the items. There wasn't a whole lot of overlap. And so anyways, I basically kind of pushed stuff back to the seller. I'm like, okay, well, they're going to make you do all this, so it's kind of, it's your problem to solve at this point. And I had personal money that was, if the deal didn't close, if the deal didn't make sense, it didn't make sense. That's part of the process. But anyways, we got to work out. The seller took off $100K. The lender went from 350, I think, down to 200. But once we subtracted the $100K from as a seller credit, then we only had to do an extra $100K, and I knew we could do it for less. so I wasn't, too worried about it. So yeah, it was a tricky deal, but I went over all that process fairly quickly, but that was a 4 or 5 month process of going back and forth with the lender, going back and forth with the seller. And, so yeah, it took about 8, 9 months to close. It was interesting.
So was most of the 8 to 9 month close, was that due to it being a CMBS assumption, or was that due to all the stuff that came up during the due diligence?
It was not the due diligence on our side. It was the due diligence on the lender side when they brought out their inspection, their engineering team and all that. That's when things really went sideways and started to kind of slide towards the.
This is very interesting though, because you would think that if it's an assumption, why would they go through all those extra expenses of trying to do all this extra work when it's basically just taking over the current note?
Well, that was our argument. I was like, look, what was interesting is the loan wasn't that old. The loan was, I don't remember the exact, I think the loan was 2 or 3 years old when we were assuming it. I'm like, well, why didn't you try and why didn't you address this up front? Why 2 or 3 years later, when not a whole lot's changed, why are you having us jump through all these hoops? And, they're a large corporation and big lenders. And, so it was hard to, and it was my first, a lot of times with the lenders, when we pick the lender, I have existing relationships with them. I already have, potentially multiple loans with this lender. And so we have a really, good, strong relationship. We had no relationship with this particular lender. So that added to everything.
So when you were going back to when you first, put some offers on this, was there anybody else that was offering on it at the same time? Or was it basically you put the offer in, you kind of were the first one maybe that came across that hit the number that they were looking for, they accepted it?
I think there were 1 or 2 other groups looking at it, but I pulled the trigger pretty quickly. As soon as I saw it, like, this is a smoking deal, I got to get this. And frankly, if this was on the market, it wouldn't have been at this price. We would have gotten beat out. So, as soon as I saw it, I'm like, this is a smoking deal. We got to get this.
So at what point during the entire process of your offers and negotiations and stuff like that, did you go and tour the property?
So initially, it's a while back. I think I submitted the offer and I had, driven it and all that. And, the owner didn't want me to tour it officially. They didn't want to let the on-site people know that they were selling. And so I had to go in and secret shop or whatever. I didn't really fit the profile of the tenant base. So I just told them I was, doing a market survey and all that. And, they were actually really accommodating, very nice. So, and which is what I find most of the time. So
basically you didn't get to go on site and do a full or real tour until you had an accepted offer.
Yeah, pretty much.
Yeah. And did you have to put any earnest money down that went hard day one, or was it after due diligence, or what was the process there?
None of the money went hard, because this was an assumption and all that, and it was their lender. So I built it in to where basically once I got acceptance from their lender that everything was good to go, then my earnest money was hard. So because it's CMBS, the attorneys and just to kind of kickstart the assumption process is very costly. So, just to get that process going, I think I had to put up $40K, which, is decent chunk of cash. So that I did have that at risk, but the earnest money was not at risk.
Mm-hmm. And did you consider, instead of doing the assumption, trying to do a different type of financing on it, or was because of the extra fees, or the yield maintenance or whatever they had on the CMBS was too expensive?
Yeah, the defeasance was about 800K, and it just didn't. The loan was only 2.8, so I mean, yeah, it didn't make sense. Although that I would have been able to close in 60 days or less. So oh well.
So at the end of the day, what was the final offer price on this? Right around like 4 million, somewhere around there.
Yes, it was. Gosh, yeah, it was right. It was. I don't remember exactly. It was 441, something like that. Yeah,
somewhere around that ballpark. And
yep.
what did you end up selling it for when you exited it?
We sold it for 7.25.
Wow, that's awesome. And 7.25, so that's roughly about 60 a door.
Yes. Yeah.
It's almost double.
That's the number I was. Yeah, that's the number I was shooting for. Yeah.
Yeah.
Well, actually, so I'd planned, as far as selling it, I'd planned on I'd planned on taking this thing to market. And so what's interesting, so the person that helped me buy the deal, I told you, is off market. It was kind of, so I really like the guy, super, super nice dude. And quite honestly, he did a lot of work, and he didn't get paid a whole lot on the buy side. So I was like, okay, well, in my mind, because I always want a win-win, I was like, okay, I'll take care of you on the sell side. And so I'd planned on selling with him, and I'd gotten 4 or 5 BOVs, and everyone was, the top number was around 7.1 or so. And anyways, someone came in and they had 1031 money, and they had a very short window. And I was like, look, guys, I would entertain offers, but unless this guy that helped me buy the deal, if you're able to take care of him, because I planned on selling through him, unless he's part of the equation, I don't want to do the deal. And so anyways, we made the deal work, and so the buying broker, or the broker that helped me buy the deal, we got him part of the commission that was structured in. And we got a really nice win for our investors, so that was awesome. And then I closed another deal with Sean Scott and Llewellyn and Hoover and those guys, so because they're the ones who sold Aspenwalk for me. So yeah, it was a win-win-win all around. Good, nice. So the buying was bumpy. On the buy side, it was super bumpy. On the sell side was probably the smoothest transaction I've ever had. So it was nice to have that.
So how did you guys come across the 1031 buyer?
Yeah, so Sean Scott, or actually, I'm blanking on his name, but one of the folks under Llewellyn and Hoover, kind of brought it up to me and like, hey, we got a 1031 buyer, and they need to pick something pretty quickly. And so I told them, we got to take care of this other broker, or I'm not going to do anything. And like, okay, yeah, we'll figure it out. And so anyways, they came back. I kind of told them, kind of the price range I was looking in. And, I was like, well, you need to be above that. Otherwise, I'm going to just take it to market and see what I get. And so they came in with a really strong offer. And yeah, so it was a super smooth process. It was awesome. It also helped that they were going to continue to use the same management company, Wayner Multifamily. So that made the process even that much smoother, which was nice.
Now, did they have to assume the CMBS, or did they get a new debt?
Yeah, new debt. And so yeah, they got, I don't remember their loan terms, but yeah, they got plenty of IO, and I don't remember if they went through Arbor or not, but yeah, they went through a known lender. So yeah.
So at that point, what in the CMBS process, was the defeasance already gone, or was it just low enough that you guys could just eat it?
Yeah, it was low enough, and our returns were extremely attractive. I don't remember exactly what it was at, but it was about 250K. So it'd gone down from 750 to 250. It was, it was manageable.
And going back to the 100K that you guys had as the seller credit, what made you guys decide to do a seller credit versus just reducing the offer price?
I don't remember. And it may have been a price reduction. I honestly, I don't recall.
Okay.
But there was 100K that was off, one in some fashion or another. It was, deducted from the price. So I honestly, it may have been just a price reduction. I don't remember.
Okay. I was just curious about that because I know some people prefer the seller credits versus the, there's just the reduction in price and stuff like that. On this particular acquisition, what was the actual renovation plan? I know you said you had about a little over 400 or so, 3,000 to 4,000 a door in renovation plan.
Yeah. So a lot of the units weren't really touched. It was, kind of
what was the vintage?
Phase 1 of 74.
Okay.
So, and I do have I have a funny story too, if you want me to share it. But, okay. So we purchased the property, and we, you always know that, you do the lease audit and all that, and you can kind of tell where the tenant base is at, right? You're like, okay, there's few folks that don't really fit our criteria. And so we're more stringent on if you don't pay, you don't stay. The management company before, and so part of the problem was we were in the sales process for 9 months. That's not, you don't want that, because the people in the office know that you're selling, or that the seller is selling, and they do, they don't, I don't want to say that they don't care, but they're probably taking their foot off the gas pedal, and they're probably a lot more lenient on who they lease to. And so so the first few months we had to clean house a little bit, and we had one particular tenant that was not very happy that he was being evicted, and was yelling at the property manager, and every name in the book, to where we had to almost call the police. And so magically, I don't know if this person did or not, but magically the office was burned down the next day. And so thankfully no one was hurt. The office was a standalone. But
this is the leasing office?
This is the leasing office, yeah. And and I'm sure but it's a lot more difficult in the leasing office. We were going to remodel it anyways, so I was just happy that it was burned down, before I did the remodel. Otherwise, I'd have been, oh my gosh, I just wasted, $25K or whatever. So, so it was, kind of a, I guess, blessing in disguise. So we got to, since the roof was gone, and it was kind of a flat roof, and it was built in 74, and it was very, there was, it was very compartmentalized. So it wasn't spacious or anything. You'd walk in and there's a small room, and you'd turn over here and there's a small room, and all that. And so anyways, it was nice because, we got to basically redo the roof. And so we put a pitch on it. And, I mean, it looked fantastic when we were done. And, so anyways, so that went really well, but it was, kind of frustrating.
Did you know for sure that it was that guy who burned it down?
We don't know. We don't have any proof. I don't have video or whatever. He did end up trying to break into the mailboxes though, a few months later during tax time, and I guess he was using a screwdriver and accidentally cut himself, and so he bled on the mailboxes, and so he did. I think he did do time for that, except a federal offense to break into mail. So, anyways, but fun times in C-class properties. But But so as far as the renovation plan, yeah, we planned on the office. Interiors weren't really updated at all. So we went in and we did, flooring, two-tone paint. We did probably about 20 of them where we replaced doors, and we kind of did a nicer, we did appliances and things like that, kind of did a nicer upgrade. We were trying to test the market a little bit. There's a B property across the street where we had a pretty good gap in rent prices between us and them. And so we were trying to, see, okay, if we spend a little bit more, can we get, 50, $75 more than we're charging for our otherwise kind of base, upgrade. So, but our kind of base upgrade was, flooring, two-tone paint, and then we'd replace the fixtures, and Wayner calls it the silver package. So, yeah, that was kind of the renovation plan. The pool hadn't worked in years, so we got that going, and we got that place looking good. We painted the exterior, just kind of cleaned up the property in general. Yeah, but I mean, the property was in fairly good shape when we bought it. Its flat roof was only a few years old. But yeah, it was, in fairly good shape overall.
Mm-hmm. And how did you, or let me ask you this. So what were the rents before you took it over?
Oh gosh. I don't remember exactly. But I can tell you that
idea as to what the rent premium was.
I know for one bedroom, I think they were in the low fives.
Okay.
Which is, for Waco's, really cheap. By the time we ended up, I can probably pull up rent rolls and stuff, but one bedrooms were at 660 or so. Mm-hmm. By the time we were selling. So I do remember that the rents were the second lowest in the submarket when we were buying. So yeah, I mean, there was plenty of meat on the bone. Similarly to the Aspen Walk property, I don't know if you remember when we talked about the cable contract. Mm-hmm. This one also had a cable contract. It wasn't a stout. It was a basic cable, and I think the seller ended up keeping it. But that was, $24K a year, and we ended up selling at, I'd have to get math out, but I think we ended up selling it at 6.5 cap or so. So 24K, 6.5 cap, I think it's about 370 grand a year, or 370 grand in value. So just, by that going away, it was pretty significant. We also did, they weren't billing back for water, so we started doing that. And I mean, that's an easy, paper change. But yeah, and the rents were just under market by quite a bit anyway. So there's a lot of meat on the bone. I think there's still some meat on the bone for the next buyer, or for the present owner too. So, mm-hmm.
What was the occupancy when you took it over?
When we bought it, it was 90, 92. We dipped in once we, when we had the fire, we had the manager, and it is more difficult to sell a unit when it's, you're trying to lease out of a unit. It's just kind of weird and awkward and all that. And I get that. Once we, so we kind of dipped into the upper 80s, while the office was down, and basically kind of, once that, I don't want to say excuse, but once everything was optimized for leasing and we had the leasing office going, I'm like, okay, it's time to, put up, either you need to get on board, or we're going to have to go get someone else. And then magically our income jumped up 10K a month. So.
And let's move to a different topic here on this deal, and talk about how you structured this particular deal with the investors.
Yeah, so it was pretty simple. Just did an 80-20 split. So the way that works is, when, if we sold, but if we did a refi, then so distributions are an 80-20, so 80 to investors, 20% to me. And then if we did a refi, there's an 80-20 split. When we sold, it was investors got basically all of their capital back, and were made whole minus any distributions that we had. And then the 80-20 split occurred after that.
Okay.
So
there was no preferred returns or secondary waterfall structures
no.
or anything like that, just a straight 80-20 split. Okay.
Yep.
And how much did you end up raising on this one?
It was around $2 million.
Okay. $2 million. And that included the reserves and the CapEx and stuff like that they were requiring and stuff.
Yes.
Okay.
Yep.
And how many investors did you end up having to get to be able to get this deal?
It was around 30 or so.
Okay. So 30 investors. And how long did it take you to get the $2 million raised?
It was pretty quick. I mean, people saw we were buying at 33 a door. We were buying at 9 cap. I mean, there was a lot to like on this one. And then it was pretty easy to see, okay, these rents are really low. I mean, I didn't have to do, and frankly, I didn't, I didn't really have to sell this one very hard at all. So, it was basically, okay, here's a quick little sheet. And as soon as people saw that initially, they're like, okay, I'm in, let's go.
Mm-hmm.
So.
And I also want to go back to the CMBS assumption there. So you had mentioned that, you could obviously help somebody and give them a few little tips with that CMBS
Sure.
assumption and stuff like that. Do you have any, maybe a couple of tips that you can think of off the top of your head that might help somebody who because I think for me, when I see one of those, I just turn the other way and run, like I don't even want to mess with it.
Right. Yeah.
I think a lot of people do that, but if you have a couple of tips that you can share with us, it might be helpful.
Yeah. So there, I'll have to dig it up and send it to you. There is actually a company that I kind of found out after the fact that helps out with the CMBS assumption process. So they know it in and out. As far as things that I learned from this particular transaction. So I've done a few Fannie Mae assumptions and the replacement reserves stay the same. That's not the case on CMBS, and maybe that's not all of them, but at least in this particular transaction, I didn't realize that the replacement reserves can move around. And, obviously, as I mentioned, it moved. I don't remember I think it started at 285 or it was sub 300. It was between 250 and 300. And for it to go from 285 to 700 was a shocker and definitely handicapped any sort of cash flow we would have. So that was an interesting thing to learn. I would say that in general, as I mentioned earlier, the fees tend to be higher. I'm actually doing a CMBS loan right now with a deal that we're purchasing, and it's a little more expensive. Legal fees are a little higher. There's a little more paperwork. But I don't know. I wouldn't be completely put off by the negative of a CMBS loan compared to Fannie Mae, at least, is there's no supplemental. So I like supplementals. I like to be able to get cash out. That's nice. But if you plan on holding for a longer period of time and the business plan is kind of set up for that, then I wouldn't be completely put off by a CMBS assumption. In fact, I would look at it as an opportunity because as you mentioned, there's a lot of people that are put off by them because they can be a pain, but you have potentially a lot less competition. And, if you just kind of, pick up on a few things to look for, then it's fine. It is this, I think this particular one was cumbersome. I don't think they all have to be, but as I mentioned, there's that company I had talked about, and I know they help out with this process. I don't know exactly what they do, but or the details, but I know they help out quite a bit, and they do this every day. This is what they eat, breathe, and sleep.
So why would somebody want to do a CMBS loan? Obviously, when there's an assumption there, obviously you kind of have inherent reasons why, because it's hard for someone to sell an asset when there's an $800,000 defeasance there on top of it. But so that's
Right.
an easy reason. But why would somebody want to do a CMBS versus doing a different type of, maybe say like a bridge loan or a Fannie or a Freddie?
Yeah, so so the deal that I mentioned that we are doing a CMBS is we're getting better terms. We're getting better leverage. We're getting better IO, more loan proceeds, and so it really juices our numbers quite a bit.
So what kind of terms are you getting? So how many years of IO are you getting on a CMBS?
On this particular one, we're getting 5.
So 5 years IO.
We're getting 75% of cost. So that includes, CapEx. With Freddie Mac, we were not going to have any CapEx rolled in. I think I don't remember if they were 70 or 75%. And then with with Fannie Mae, they were 65%. You could roll in CapEx, but their leverage actually, it wasn't, even it being a lot lower leverage, it was actually just because your debt service is a lot lower. But the fact that they rolled in CapEx, the numbers, were decent. But the CMBS, it just really, juiced the numbers for us. So
what kind of interest are you seeing on the CMBS?
Right now, we're in the low 4s.
Okay. And is that floating?
No, fixed.
It's a fixed.
Yeah.
Okay. Interesting. So what is it that makes the CMBS so complicated though? Like with more paperwork and stuff and more expensive?
The problem is that it's, like Fannie Mae and Freddie Mac, where they have their standard paperwork. With CMBS, each bank has their own paperwork, so it's not standardized. And so it's just when your attorney is used to looking at Fannie Mae paperwork and Freddie Mac paperwork, and then they see the CMBS paperwork, okay, well, this is different than that CMBS guy, and this is different than that CMBS guy. So it's just not standardized. That's the issue.
Okay. And
so,
how long does it take to usually get that? So like, if, for example, normally a Fannie Mae, Freddie Mac, you got a 60-day close, 30 with an extra option for another 30. You have plenty of time. Most of ours, we're getting done within those 60 days to close. It doesn't usually have any issues. Does a CMBS usually take longer than that?
Well, I guess I'll be able to come back and tell you, but once we close. But we were told 60 days, and this broker that we're working with, who does a lot of business, said that they've seen stuff to where they can beat that 60 days. So okay. With CMBS.
Okay, so it's not necessarily on the front end that it takes very long, but on an assumption is where it might take a little bit longer.
Potentially. I think, I don't know all of the issues that occurred. But there was probably, people were probably not moving as quickly as they could have been moving, is part of it. And then, not working with someone that is accustomed to doing these assumptions, was, probably that's, kind of a lesson learned for me. So, if I see another one, I know who to go to.
Yeah. Okay. All right. And so kind of coming towards the end here, can you think of anything else that came up as far as like issues throughout this entire process, even after you closed on it and you started to implement your value play? Anything else that came up during the hold period that, might be interesting for us to kind of, dive into a little bit?
I guess, Yeah, I mean, nothing comes to mind per se. I would say that, when the office was down, our income was lower, and so we didn't, because income was lower, I wasn't able to do distributions, and I don't know all the deals you've been in, but I like distributions. I want distributions. I don't really get paid until I send money out to investors. And so, I had a few investors that were, hey, what's going on? We want some money. I'm like, I'm working on it, So once we got the office up and going, our income, like I said, jumped up 10K, and, and over, as we were selling, which is what a buyer wants to see. We're very much trending in the upward direction. Our NOI jumped up 34% from the time we bought it to the time it closed, which is nice. We've done water conservation. We hired a company, American Water. I've used a few others, but we saw some nice water savings there as well. But yeah, once we got the office solved, everything kind of, once we kind of got past that hurdle, everything kind of fell into place, and I was able to start doing distributions, and everybody's happy. So.
Mm-hmm. Well, cool. So what did you find that was easy during this entire process that you might have originally thought was going to be a little bit harder?
What was easier and I thought was going to be harder? I would say that, I guess, I'll talk to another thing that was a little more difficult, for us, the labor pool, in Waco, and getting contractors there is more challenging. There's not, Waco's a decent sized city. It's 120,000 people or so. The MSA is about 250, but there's only so many managers. There's only so many maintenance people, and so we had difficulty there. And as far as contractors and paying, a decent rate, we had to end up pulling people from DFW to come down to give us a pretty decent bid. So that there were some challenges there. I would say once we got the office going, that was, income really started humming. And so all of that whole just NOI just kind of jumping up process was very refreshing, and was I guess I didn't expect to see that sort of jump that quickly, and so that was nice, and so that was a little easier than I thought it was going to be. I thought it was going to be a more gradual climb for income.
Mm-hmm. Okay. And I always ask another question, but I think I could probably answer this about what did you find was harder than expected during the process? And that was probably the 9 months to close it.
Yeah, that was, well, it's interesting too on the, cause I'm basically a liaison for my investors, right? And they're like, so I'm, updating them, every few weeks or once a month just to kind of let them know what's going on. They're like, are we really going to close? Like, what's going on? And I needed some people needed to close before the end of the year. So I literally closed like it was I think it was December 28th, or it was
Wow.
whatever that right before the weekend of the first, I literally closed that Friday. So I told the seller, I told the lender, I'm like, we have to close in. Cause he was trying to push into the next year, for tax purposes, just so he could, go invest in something else or whatever he's going to do. And I was like, nope, gotta close in. So we got it done. I think it's 28th or something like that.
So speaking of that, obviously the investors are expecting a certain, 80-20 split, and some starting to get a return. So you basically were holding on to their money, I'm assuming, for probably, 7-8 months while you're trying to get this thing closed, just sit into an account, right?
Yeah. Yeah.
Yeah.
Well, I thought we were going to get going at any time, and it was a lot of, oh, nope, still gotta wait.
Yeah.
So it was interesting. Yeah.
Yeah. Well, I really appreciate you coming back here, Dustin, and sharing a lot of information about this particular property, the 120 unit one in Waco, Fleetwood Square. Glad it went really well for you as well as your investors. How can listeners who are listening to us right now, if they have questions for you, obviously about CMBS, they can ask you, but even if they want to possibly join you on a future deal or something like that, how can they reach out to you and discover you a little bit more?
Yeah, the best. I'll give you my email. It's Dustin@milesmultifamily.com. They feel free to email me, and happy to help any way I can. So,
well, thank you so much again, Dustin. I really appreciate it, and looking forward to having you back again.
awesome. Thank you. All right, and see you in a few weeks in Dallas.
Sounds great.
See ya.